Mike Tedeschi, Wealth Management Advisor with Perspective Wealth Planning, with this week's market breakdown video. In this video, we're going to take a look at the four major U.S. indexes. We're going to take a look at some breadth readings. We'll look in at the commodities, the U.S. dollar, emerging markets as well, and we will take a look at the dumb money, smart money confidence indicator. Now, before I get into what happened here this week, which of course has been a lot, I want to talk about when markets kind of get out of control and how you can kind of spot those. We've talked a lot about a number of factors here over the last few weeks that had me starting to get concerned. First, let's take a look at breadth reading. When we take a look at the Nasdaq McClellan Summation Index, the Nasdaq had been making new highs continuously here over the last few months, but the breadth readings in the Nasdaq were not, meaning more names were not confirming that push to the upside. In fact, the percentage of stocks underneath the 50-day moving average in the Nasdaq continued to drop while the indexes continued to make a new high. That is cause for concern. We pointed out that it failed right at that level from where we had that big pullback starting in 2019, where the market kind of got stretched to the upside and then we started that sell-off. Right? This was a concern, and as always, it doesn't matter until it does. Right? We basically had June, July, August, and almost into September where this was continually dropping while the market was making new highs, and it didn't have an impact. But yesterday, when we saw that sharp sell-off and the Nasdaq was down over 5% on the day, right? This certainly was important, right? That is part of the reason why eventually those couple of names that were holding the market up, they also fell, and subsequently you had that sharp sell-off. So when I point these things out, it doesn't mean that it's going to happen immediately. It just means you need to be cognizant of the risks that are presented. And the other risk that's still a risk for us is the dumb money, smart money confidence indicator. We are still extremely stretched. We did not get much of a close there off of one day. We're still really wide open. And when, again, you look at that, look at what happened earlier this year. You had the dumb money extremely confident, the smart money very concerned, and then you had that happen. Well, here we are again with it very stretched, and we have the potential for it. Doesn't mean we're going to break over. We're going to go through a lot of different levels on charts today that are important to pay attention to. But, this not closing that much is still a concern. We still have a wide spread between institutional and retail investing. And we saw a couple of things happen, and we talked a lot about different option data in terms of the amount of calls versus puts that were open, the amount of retail speculation that had been going on. And one of the other signs was if you looked at the largest company in the world, if you looked at out of the money calls versus out of the money puts, the out of the money calls were almost 3 times as expensive as the puts. I mean, people were paying up extra money for this rally to continue, and people did not think that subsequently it would fail. The boat was very, very loaded on one side, and one of the things that we're going to now look at, we're going to look at the S&P 500 going back into 2018 the beginning of 2019. Now, we have an angle of ascent that happens after a long run-up, right? So we've had a couple of years of push to the upside, and we have this angle of ascent. Then we get into the beginning of 2019, and we get a rocket higher. You can see how the angle of attack has changed from this 45-degree angle to this. This usually is not sustainable. It doesn't mean that you're going to have a huge breakdown. What it usually means is at least, at a minimum, you're going to do something like this. You're going to trade sideways for a while. The market will digest the move and then continue on. But when you have a huge move to the upside and then you get that final kind of move up, some people call that parabolic type move, and you have some quick, swift move to the downside, which is what we had in the beginning of 2019. Well, now fast forward to today, and let's look at the Nasdaq here. Well, we have had quite a run, obviously, this year. It's still up 30+% for the year, and here's that kind of angle of attack off the lows there in March, and then look what happens over the last 2 weeks. We get that really big push to the upside. If you're looking at individual names, there were some stocks that were up 400 or 500% off of the bottom that jumped large, had a larger move than it's ever had in the history of the stock on other companies' earnings. And they hadn't reported yet because the market went, oh my goodness, they blew earnings out. These guys have to blow earnings out. And we had these big gaps up on Wednesday. And on Wednesday, we had that first kind of shot across the bow. The Nasdaq had a gap up. It was actually down 2% at one point during the day and rallied back up. Did not make a new high. That was kind of the indicator that we might be in for some trouble on Thursday. And then Thursday, we ultimately made that rollover, and we saw selling across the board, across the entire market. Now, the question on everybody's mind comes in here, what now, right? We had that big, sharp sell-off one day. Is that it? Or are we now in for a bumpy ride here moving forward? Well, this is the channel that the Nasdaq has traded in since that low back in March. You can see prices stayed inside this upward channel. We haven't broken that yet, right? We haven't broken any major levels. All that yesterday did was essentially undo about a week and a half, 2 weeks worth of gains, which again was that very frothy kind of over the top move, which wasn't going to be sustainable. All right, we knew that we were going to get one of two things to happen. We were going to have a sharp pullback, or we were going to trade sideways for a while. But basically, the market needs to digest some of this move. We haven't had any real pullbacks since that bottom. We've basically just gone straight, completely up. And we have retail traders that are extremely bullish, while institutional money is very concerned at this point in time. Option data, a lot of different, negatives essentially sitting out in front of us. So, if we're looking at the Nasdaq here, what are the key levels to watch? Well, the bottom of this channel is really important, and that breakout at about 11,250 is going to be an important zone. And then underneath of that, we're looking at 1030, and then we've got that all-time high breakout point from February that we ultimately broke out there in June at about that 9,800 level. Those would be those moves on the downside. When we look at this from a fib retracement, right, typically tend to try to take a look at the market moves kind of in two steps, right? It makes the stair step up and then kind of retraces half of it and then continues, right? Both on the upside and the downside, right? So example in the sell-off, we had that bounce, that sell-off, then we had the bounce, and then we rolled over, all right? And so if we're looking at it like that, right, where is that 50% retracement level from this move? And that 50% retracement level from that move comes back to right about where that breakout was back in June. So that's really, really, really the most important level when you're looking at this for the bulls at the end of the day to defend. A move back underneath of that would be really, really bad. We're nowhere near that at this point. I just wanted to put the bigger picture up here on this chart. Remember, we've made an incredible run from March. We can't just continue to go straight up forever. That's not how markets work. So we're either going to trade sideways for a while, or we're going to start to come back and test some of these levels. When we take a look at the other indexes, very, very similar. All right, we take a look at the S&P 500. Where would that 50% retracement level be on this, guys? We would be looking at right about that breakout spot from in June, about that 2,900. Now, there's a lot of levels on the S&P 500 before we get there. Again, I think the most important short-term level would be this gap up from a couple of weeks ago, right there at that 3,400, which also, if I extend this out to the left, you guys will see that's that all-time high breakout. 3,400 is an important level to hold. Then it'd be about 3,280, and that zone would go down to about 3,200. This whole area right in here was an area of resistance. Below that, you've got that 2,970 zone on the downside. All right. We take a look in at the Russell 2000, right? We have all of the levels still laid out from before on the chart. 1600 was that big level that we were watching. Of course, that's kind of where it got rejected at. And look what it did. It closed all the way back down from that 1600 down to that important 1540 zone from the breakout back there in the resistance in the high from June, and then the breakout back a couple of weeks back. That's what we're watching there, and then below that, again, the 50s are still the important, the 1450, 1350 zone on there. Now, the Dow Jones, all right, didn't make that new high. Did try to push above it on Wednesday, got above that gap finally, which was a good thing. That had been that area of resistance that it just couldn't get above, and then really big move. Undoing that breakout right there underneath of this zone now. So it's underneath that gap zone. They need to reclaim that 28,400 level, and supports, we're looking at 27,500, and then we're really kind of going to look back at about that 26,000 level, and below that, that 25,000 level is what we're going to be watching over there. Now, we take a look at the emerging markets. Emerging markets running right into that area that it's just not been able to get above here, really since that sell-off there in the beginning of 2018. So we're watching this area real closely, and that's at 1150 to that 1100 zone, and it is holding right there on it right now. So this whole area in here is that big kind of resistance zone. Failed here, a lot of price action back in it here. A move above this really gets interesting, and we're still paying a lot of attention to the emerging markets because of what's been going on with the U.S. dollar, but a failure right up here really opens up that 1050 zone to that 1025, this gap right in here, and then below that really this gap back down until 925, 950. Since we talked about the dollar right here, let's jump in and take a look right at it. The U.S. dollar continued to make new lows, made a new low this week, and then has bounced. If we look at this on a daily chart, you can clearly see that we are continuing to grind inside this downward channel. It's not really breaking down. It's not really pushing up. It's just slowly kind of drifting lower. And we look at this on a weekly chart again, right? That 91 is that zone of support. A break above this channel would be bullish for the U.S. dollar, and we would be looking for a kind of a move back up to that 95, 96, which could weigh on the commodities and the emerging markets as well. So we'll continue to pay attention to what's going on there. A lot of times the dollar will trade in a range for quite some time before making that next directional move. I think you're going to have to see some sort of news out of the central banks in order to really push this either up or down at this point. We'll probably just kind of drift around in between that 91 and 94 zone here for a while until something along those lines changes. We had oil starting to make that break down. It has kind of recaptured it at the moment at 41.50, which is that gap zone. Really is very, very important, right? You can see we've basically traded above and below it here for quite some time. We did push below it yesterday and things started to look bad. It ended up bouncing and is now right back at that 41.50 zone, but no real appreciation in terms of price since really June. So no kind of follow through to the upside here on oils, just trading right around that level. If we get that push up, could show that there's actually some good demand underneath the surface for the economy. At the moment, it's just kind of treading water sideways. Copper is holding at that right at that $3 level. We talked about this a couple of times, the importance of what copper means from an economic standpoint. It's right there at that $3 level. It's had a couple of days of weakness, but it continues to pop right back up. 330 would be that next target in there. And the precious metals are really just kind of trading sideways here. This is a healthy way for the indexes themselves to go, right? Gold had a real huge push. Again, and if we look at this on a daily chart, we had basically the angle of ascent for gold over the last 6 months or so was about this, and then we had a move like this. And what happened? We had that sharp sell-off, but notice it didn't continue to fall, right? It is now traded sideways for a while and is kind of working through this move. And that's the constructive action we'd like to see out of the indexes. This would be a good example of how that essentially could work. On the Dow, on gold itself, we want to see kind of a move back up over 2,000 or a move back below 1,900 for that next move. So those are going to be the two levels that we watch there. Silver looks very, very similar. Let me take a look at that. Holding over that 26, same type of thing, right? Angle of ascent, and just really kind of went out of control. Real quick move to the downside, and then it's kind of essentially traded in a range here with no real appreciation here over the last couple of weeks. A move under 26 would be bad for the bulls, and a move really over like 28.50 and holding over it would be really good, and that's where we would kind of see that next move to the upside. Now, last but not least, what I want to do is I want to take a look at the S&P 500 here, and I'd like to clear all the lines out, and I'd like to just look at it on a monthly time frame. I like to do that at the end of every month, take a look at the monthly candle and see how things went. What I want to say is what we've got potentially here is really the market is kind of traded in this kind of zone here for a couple of years, right? And when you get a couple of years, even with some volatility in there, like we had from 14 through 17, right, where we did have some of these, big volatile times, right? When you do make that breakout, a lot of times you get that big follow through. holding over that 3,200 level on a monthly time frame is really, really important. My concern, of course, is that we have been on quite a run for quite some time, right? I mean, we have made an incredible move here from 2009, and eventually, right, it doesn't have to be here, but eventually at some point in the future, that bull run is essentially going to stop. Central banks obviously still supporting this market. The action that we saw here, on Thursday, when you look at it on a monthly candle, really nothing to be super concerned with at this point. But we really want to see that continued follow through here to the upside, and I really would like to see that 3,200 level hold on a longer time frame chart. On the short term, we laid out some levels for you guys to pay attention to. Remember, when things get overheated, it doesn't mean the market is essentially going to have to collapse. We could do something like gold, where we trade sideways for a while as we digest that move. We have the U.S. elections coming up, so there's going to be some uncertainty here in the near future as well. We're probably in for some volatile, choppy trading here for quite some time until those issues get resolved. Manage your risk. Trade the levels, and if we really start to see a deeper correction, we'll of course lay out what that can mean and what happens when certain levels get breached in these videos every week. So as always, guys, if you want to get a hold of me, you can reach out at mtedeschi@perspectivewealthplanning.com. I'd love to talk and shop with you guys. Any questions that you have about the market, you also can pick up the phone and give me a call at 814-580-9881. I hope you guys have yourselves a fantastic week. Manage your risk. I'll see you next week. Take care.